Hold on to your hats, folks, because the stock market can be a wild ride. It's like being on a roller coaster, where the highs are exhilarating and the lows can be downright terrifying. One minute you're cruising along, portfolio fat and happy, feeling like a financial genius. Your investments are growing and everything seems to be going according to plan. The next, bam, you're staring down the barrel of a terrifying crash. The value of your investments plummets and it feels like the ground has been pulled out from under you. It's enough to make even the most seasoned investor break a sweat. The stress and anxiety can be overwhelming and it's easy to feel like you're losing control. But fear not, dear viewers. I'm here to tell you that stock market crashes, while scary, are a natural part of the economic cycle. Just like the seasons change, the market goes through its own cycles of growth and contraction. Like a bad case of the flu, there's something we all have to deal with from time to time. It's an inevitable part of investing, and understanding this can help you stay calm when the market takes a nosedive. The good news is, with the right knowledge and a healthy dose of courage, you can not only survive a crash, but even come out ahead. It's all about having a solid plan and sticking to it, even when things get tough. That's right, you heard me correctly. While most investors are running for the hills, screaming and selling their stocks for pennies on the dollar, you, my friend, can use this as an opportunity. It's a chance to buy quality stocks at a discount. An opportunity to buy low and sell high. When the market recovers, and it always does, those who were brave enough to buy during the downturn can reap significant rewards. An opportunity to turn market chaos into your financial gain. By staying informed and making strategic decisions, you can turn a crisis into a chance to build wealth. So, buckle up and get ready for a crash course on surviving a stock market meltdown. We're going to explore the factors that lead to these crashes and how you can prepare yourself mentally and financially. We're going to delve into the nitty-gritty of what causes these crashes, how to keep your cool when everyone else is losing theirs, and most importantly, how to use proven strategies to protect and even grow your wealth during these turbulent times. Let's do this. Together, we'll navigate the stormy seas of the stock market and come out stronger on the other side. So, what exactly causes these heart-stopping market crashes? Think of it like a Jenga tower, where each block represents a different factor influencing the market. You've got your economic indicators like inflation and interest rates, political events both domestic and international, and of course, good old-fashioned market speculation. When these factors start to wobble, whether it's due to a sudden economic downturn, unexpected geopolitical events, or a bursting asset bubble fueled by rampant speculation, the whole tower can come crashing down. Remember the dot-com bubble bursting back in the early 2000s? That's a classic example of what happens when irrational exuberance and speculative trading meet a dose of reality. But fear not, fellow investors. Understanding the root causes of market crashes is the first step towards navigating them successfully. By keeping a close eye on economic indicators, staying informed about global events, and being wary of market bubbles, you can better anticipate potential downturns and position your portfolio accordingly. Remember, knowledge is power, especially in the unpredictable world of finance. Now, let's talk about the most important thing during a market crash: keeping your cool. When the market takes a nosedive, it's easy to get swept up in the fear and panic. You see your portfolio shrinking by the day, and your gut instinct screams at you to sell everything before it all goes to zero. But here's the thing, folks. Panic selling is the worst thing you can do during a crash. Why? Because it locks in your losses. Remember, the stock market is driven by emotions, and fear is a powerful motivator. When everyone is selling in a panic, prices plummet, often far below their true value. Take a look at the Nifty 50 chart above. See those sharp drops? Those are moments of panic. But notice something else? The market always recovers. Always. It might take weeks, months, or even years, but it always bounces back. And when it does, you want to be positioned to reap the rewards, not kicking yourself for selling at the bottom. So, the next time the market throws a tantrum, take a deep breath and remember the age-old adage, don't catch a falling knife. Instead of panicking, focus on the long game. Remember your investment goals and stick to your plan. Section 4. Technical analysis. Spotting the bottom with charts and trends. Alright, now that we've covered the importance of staying calm, let's talk about some strategies you can use to not only survive a crash, but potentially even profit from it. And that's where technical analysis comes in. Now, I know what you're thinking. Technical analysis, isn't that just a bunch of mumbo-jumbo and squiggly lines? Well, let me tell you, there's a method to the madness. Technical analysis is all about identifying patterns and trends in stock charts to predict future price movements. Think of it like reading the market's body language. By studying things like moving averages, support and resistance levels, and trading volume, you can get a feel for where the market might be headed. Take a look at this chart of Reliance Industries. See those horizontal lines? Those are support levels. They represent price points where buying pressure has historically been strong enough to overcome selling pressure, preventing the stock from falling further. During a crash, these support levels can act like a floor, providing a potential buying opportunity for savvy investors. Of course, technical analysis isn't an exact science. It's more of an art form, requiring experience and intuition to interpret the signals correctly. But by understanding the basics and using it in conjunction with other tools, you can gain a valuable edge in navigating market volatility. Let's delve a bit deeper. Historical data shows that markets have always recovered from crashes, often emerging stronger. By analyzing past trends, you can identify recurring patterns that signal a market bottom. For instance, candlestick patterns like the hammer or doji can indicate potential reversals. Additionally, indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, can provide insights into market momentum. Combining multiple indicators can give you a more comprehensive view of the market's health. Remember, no single tool is foolproof. It's the combination and how you interpret them that makes the difference. The goal is to make informed decisions based on a blend of technical signals and market context. Continuous learning and adapting to new information is key. The market is ever evolving, and so should your strategies. With patience, practice, and the right tools, you can turn market downturns into opportunities for growth and profit. So, keep honing your skills, stay informed, and trust in the process. Happy trading. Happy. Section 5. Fundamental analysis. Finding value in the rubble. Technical analysis is all well and good, but what about the underlying businesses behind those stocks? This is where the real value lies, beyond the charts and graphs. That's where fundamental analysis comes in. It's the backbone of smart investing, providing a deeper understanding of what you're actually buying. It's all about digging into a company's financial statements, evaluating its management team, and understanding its competitive landscape to determine its intrinsic value. This means looking at earnings, revenue, debt levels, and even the company's future growth prospects. Now, during a market crash, even the best companies can see their stock prices plummet. This can be alarming, but it's important to remember that the market's reaction is often driven by fear and panic. But here's the thing. A crash doesn't change the fundamental value of a solid business. The company's products, services, and market position remain the same. In fact, it often creates opportunities to buy great companies at bargain prices. These are moments when the market's irrational behavior can work in your favor. Think of it like a department store sale. When prices drop, it doesn't mean the quality of the items has diminished. Suddenly, that designer suit you've been eyeing is 50% off. It's the same suit, just at a more attractive price. Is it because the suit is suddenly worth less? Of course not. The value remains, but the price has temporarily dropped. It's just a temporary discount, a chance to snag a great deal. This is the essence of finding value in the rubble. Take HDFC Bank, for example. It's a well-established institution with a strong reputation. It's a fundamentally sound institution with a long track record of profitability and growth. Its financial health is robust, and it has a solid customer base. During a market crash, its stock price might take a hit, reflecting the broader market sentiment rather than the company's actual performance. but its underlying business remains strong. The bank continues to operate efficiently, serving its customers and generating revenue. This presents a golden opportunity for long-term investors to buy into a high-quality company at a discounted price. It's a chance to invest in a reliable business at a fraction of its true value. Remember, folks, the key to successful investing is to buy low and sell high. This principle is timeless and applies especially during market downturns. And during a market crash, you have the chance to do just that. It's a time when patience and a keen eye for value can pay off handsomely. By focusing on the fundamentals and identifying companies with strong underlying businesses, you can make informed decisions that will benefit you in the long run. You can turn market chaos into your financial gain. Strategic investing during these times can set you up for significant returns as the market recovers.